Good morning, students. Welcome back to the session on audit. Yesterday, we had a discussion about peer review and quality review. And again, we are meeting very soon. In the next few days, we are going to have various sessions around various chapters. And I'm just hoping that you will be able to keep the pace, and also considering that your exams are so near. So it will really be helpful to all of you. So we plan to start with a new topic today, audit under fiscal laws, which majorly talks about two things and which are very commonly known these days, particularly GST audit, which is a new thing in the sense that this GST is all new. Things are settling in terms of GST. A lot of developments are happening in GST. And the other thing is about tax audit. Tax audit again is a very important area for various organizations. Very important audit from the regulatory side, and a lot of consideration is given to this type of audit because the income tax computation of any entity is involved with this. The other interesting thing about these two type of audits is that these are not limited to any company, so they may apply to any entity on the basis of certain criteria which have been established. So we are now talking about not only a company, but in respect of any entity, be it a partnership firm, be it a proprietorship firm, be it a firm which is into professional services, which may be rendering some of the services. So it can be also covering any sort of business. There's again no limitation as regards the industry or the business or services which it may be providing. So we'll start first of all with the requirements related to tax audit under this fiscal law. And after completing the tax audit, then we will move on to the requirements related to GST audit. So beginning with tax audit. In relation to tax audit, as the name only suggests, it's an audit which is required to be conducted, and that audit is required as per the requirements of Income Tax Act. For this audit, it will be very important for the auditor, again the auditor is going to be involved in this case as well, to have a thorough knowledge of Income Tax Act. Because in case the auditor doesn't understand about the income tax, or maybe some of the things which are required to be addressed by the auditor in relation to tax audit, let's suppose if he doesn't know about those taxation requirements, he doesn't have that knowledge about taxation, then he will not be able to audit. And the same thing will apply to us also. When we will discuss this chapter, or when we are going to discuss this topic about tax audit, we can just break this into two parts. Each and everything in this topic will require a prior understanding of income tax. And if we don't understand that provision, that section, that requirement of income tax, then we will not be able to understand, we will not be able to assess as an auditor as to what can be the audit procedures in relation to that requirement, which this tax audit will cover. Okay, yeah. So let us quickly understand about some basic requirements to start with. Now, what is this tax audit? Tax audit comes from the requirements of Income Tax Act. Unlike statutory audit, a company, I'm taking an example of a company, may be preparing its financial statements. And after preparation of the financial statements, those are audited by the auditor. So if any regulatory authority wants, any regulatory authority, they can have access to the audited financial statements of the company. And that's why they can have some reliance on the books of accounts of the company, on the financial statements of the company. Why? Because those are audited. Those have been audited by the auditor. So that's why some sort of reliance is placed on those financial statements. Otherwise, the reliance cannot be placed. But there are certain problems over here. One, the way books of accounts are prepared as per the Companies Act may not align with the requirements of the Income Tax Act. Let's understand some of the differences, some of the requirements of Income Tax Act which may be different from the way books of accounts are recorded or prepared. First, it could be related to depreciation. Under Companies Act, depreciation is recorded, depreciation is computed on the basis of useful lives. And when I say Companies Act, it would mean the accounting standards. It could be any set of accounting standards, Indian GAAP or Ind AS. Both of them are covered over here. So it would mean the accounting standards which require useful lives to be considered. Whereas Income Tax Act does not consider useful lives. Income tax has a different way. Income tax has a different way to compute depreciation based on the depreciation rates which the Act has prescribed. And we know, all of you must have dealt with this, that rates of depreciation of income tax are different from what Companies Act will require. So one area. So we can see there's one problem in relation to the audited financial statements which the auditor may have. So the first point, if we talk about tax audit. So we are starting with financial statements and we are talking about differences between books and requirements of income tax. Okay, so first point which we understood is about depreciation. So we can say first example is depreciation. Number one. Any other example that comes to your mind? Any other example wherein you can think the difference exists between books of accounts and the requirements of income tax? Next could be about some of the expenses which are recorded in the books on the basis of accrual system. Books are prepared on the basis of accrual system, whereas income tax may not allow recording of those items, or we can say income tax may not allow those expenses on accrual basis. Instead, income tax may allow those expenses to be considered on payment basis. So we are saying accrual versus payment basis. And there are many items which may get covered over here. A lot of provisions which are created under the books of accounts are not allowed by income tax. Why? Because Income Tax Act says that when you will pay those amounts, then you can claim those expenses. Okay, yeah. Now, some of these problems we have discussed, but we are not getting into the detailed requirements of Income Tax Act. Now, because of these problems, let's understand what is the problem which may arise. So there will be profit or loss, which will be shown by the financial statements, which will be shown in the financial statements, or as per the books of accounts, some profit or loss will exist. And income tax will require income tax to be computed and filed in the form of income tax return. So we are talking about income tax return. Now the question arises that whether the same profit or loss can be shown in the income tax return, on which income tax can be computed and that can be paid to the income tax department. The answer is no. Various adjustments will be required in this. What are those adjustments? These adjustments will be required. Yeah, once these adjustments have been made, then the number will flow to income tax return. So we are talking about these adjustments. So we are talking about various adjustments which will arise, and without these adjustments, income tax return cannot be accepted. Okay, and all of us know about this, that all of these adjustments are required to be made. It's a very basic thing, and you may be thinking, yes, it's true, and this is something which is done by all the entities on a regular basis. So where does this tax audit fit in this entire concept? Now, tax audit captures the requirements related to all of these adjustments. All of these adjustments which the management of the company, so we are talking about a company now, all the adjustments which the management of the company would have captured or should have captured are required to be, first of all, placed in a separate form. That form is called as form number 3CD. Yeah, so it's like any other form. It's like a form, for example, you fill your form for examination. So there are various particulars required to be filled. Similarly, this is a form in which various particulars are required to be filled, and most of these particulars relate to these adjustments which should be made by the company when they move from their profit, which is shown as per the financial statements, to the profit or loss on which income tax should be computed, or which is also technically called as taxable income or taxable loss. Okay, yeah. So we are saying that why does it come? So we are saying there is a form 3CD which is prepared by the management and which is required to capture all of these adjustments. Now the management can fill this form, and after filling this form, management can capture all of those adjustments in income tax return. But now a problem arises. The problem is about two things. First is about audit of this financial statements, which is sorted in case of a company. For a company, audit of financial statements is done. It's sorted. Because this is the starting point. If this profit or loss is wrong, then all of these adjustments, even if these are captured in this form and submitted to income tax, that is of no use, because the base has to be corrected first of all. So in case of a company, this base is corrected, or the base is something on which reliance can be placed by having this audited. So this is audited in the first instance. But all of these adjustments which will flow in this form number 3CD, how can somebody get to know whether these are correct or not? Yes or no? Because there could be certain errors in all of these adjustments which may have been filled in form number 3CD. Yes or no? Yeah. That's why, to ensure that the particulars which are flowing in this form number 3CD, an audit is required. And that audit is termed as tax audit. In case of tax audit, what will the auditor do? Auditor will not get into audit of financial statements. No. Instead, he will get into checking of this form number 3CD. He will ensure that the particulars which are going into form number 3CD are correct or not. That's it. Because in case this has been ensured, then remaining things can be taken care of by the management, because they can fill this income tax return in a right manner, because they will have all of these particulars available at two places: financial statements plus the adjustments. And same thing, if required, can also be accessed by the income tax department and can also be verified by the income tax department. Okay, yeah, clear on this? Clear on this aspect as to why this audit may be required? Yeah. Now moving on to another point related to non-corporates. So in the first case, we discussed about company, wherein our problem was already halved. because financial statements of a company are already audited. But let's talk about non-corporates. Now, in case of a non-corporate, audit is not mandatory. We are again not talking about tax audit. We are talking about non-corporates in general. First thing is, let's say it's a partnership firm. Say if we are talking about a partnership firm, now partnership firm is also required to pay income tax, file income tax return, for which partnership firm will also be required to prepare financial statements to ascertain what are their profits or losses during the year, and partnership firm may also require all of these adjustments to get to the income tax for the year. Now, for a partnership firm, in a way, like we talked about company, we can also get this form number 3CD filled. And on the basis of audit of this form number 3CD, all of these adjustments can be ensured whether those are correct or not. But what about this financial statement, which is not required to be audited for a partnership firm? It's not mandatory. So it may happen that the partnership firm prepares the financial statement. Yeah. So if those are not audited, what will happen? The base numbers with which we will start in terms of considering all of those adjustments, audit of those adjustments, will that really be helpful? The answer is no. The answer is no. So that's why we need to see some mechanism through which this problem can be addressed in relation to non-corporates. So we'll have to understand as to what is that mechanism through which non-corporates will also be in same situation which the companies were into. Okay, yeah. So I'm not getting into that mechanism right now. We'll come to that. We'll come to that in some time as to how this problem can be sorted in case of a non-corporate. But with this, what we have tried to understand is the requirement of this audit and what this audit will really cover. Yeah. So let us now move on to the requirements related to tax audit. And as I told you that all of these provisions related to requirements of the tax audit come from the Income Tax Act. So it's all about knowing the provisions of the income tax. So that's why I'll not get into too much details around it, broadly covering certain aspects, and some very, very common aspects around it are the criterias which are based on turnover, which says audit of accounts of certain persons carrying on business or profession are required to be is mandatory in following cases. So let's see what is that. Every person, and please understand the term used here is person, and person can include any entity, any person who is carrying on business shall, if his total sales, turnover, gross receipts, as the case may be in a business, exceed or exceeds 1 crore rupees in any previous year. Means the threshold is 1 crore turnover. So if that exceeds 1 crore, then the tax audit will become applicable to that entity. For example, in this case, there is a partnership firm, and let's suppose this partnership firm will have turnover of rupees 5 crore. Okay, so in that case, audit of this form number 3CD will become applicable, otherwise not. So let's suppose if the partnership firm which is carrying on this business will have a turnover of 25 lakh rupees during the financial year. So we are talking about financial year. Every financial year this needs to be assessed. So in such a case, tax audit will not become applicable. Correct? Yeah. Similarly, every person which is carrying on business. So first was the word business. Sorry, second is carrying on profession. Every person carrying on profession shall, if his gross receipts in the profession exceed 50 lakh rupees. Now the threshold is 50 lakhs in case of professional services. Who can be the professional? Chartered accountant can be a professional. Lawyer can be a professional. Doctor can be a professional. Yeah. So all of these professionals will have to look into this different criteria because they will show their income as professional income and not as business income. Yeah. Then the third aspect is about consideration of presumptive taxation. Presumptive taxation means certain taxation requirements wherein income is considered on the basis of those presumptive taxation norms. Now, in relation to those presumptive taxation norms, tax audit becomes applicable provided the threshold in terms of the profits which are shown are not crossing a particular limit, which is again prescribed in the Income Tax Act. Okay, so broadly we can say these can be the three criteria on the basis of which tax audit will become applicable. But very commonly what you get to see is about this business or professional income, which really is required to be considered. Now comes the question that in relation to this tax audit, which becomes mandatory on the basis of the criterias which are specified in the income tax. So all of you, please remember, this income tax you need to remember. This income tax you need to understand very thoroughly. Now question arises, who can be the tax auditor? So is it that every auditor or every person or every firm which can audit the financial statements of a company can also audit the form number 3CD? So what's the criteria? So how do we assess or how do we find out the tax auditor in this case? So this has also been captured over here, which says accountant can audit the form number 3CD of an entity. Now who is an accountant? Accountant means a chartered accountant as defined in section 2 of the Chartered Accountants Act, who holds a valid certificate of practice. So that means we are talking about a chartered accountant holding a certificate of practice who can be considered for the purposes of tax audit. When I'm saying considered, because there are various practicing professionals, or we can say practicing chartered accountants. So any of them can be considered. Now penalty for not getting the accounts audited under section 44AB. 44AB is about this tax audit. According to section 271B, if a person who is required to comply with 44AB, that means who is required to get his tax audit done, fails to get it done in respect of any year or years as required, a penalty may be imposed on him, which shall be lower of following amounts. Means lower of these two. 0.5% of the total sales, turnover, gross receipts, as the case may be in business, or gross receipts in profession in such year or years, or 1.5 lakh. Lower of these two. Okay, yeah. However, according to another section, all of these sections are the sections coming from income tax. And you may be thinking, sir, are we covering income tax or audit? So currently we are going through some basic requirements of income tax, and then we'll move on to audit requirements also. But all of you, I'm just repeating that for you to understand this tax audit, you need to understand all the requirements of income tax, at least those which will be covered under this form number 3CD or which will relate to tax audit. However, according to section 273B, no penalty shall be imposed if reasonable cause of such failure is proved, which generally is not available. So that's why you should consider that this penalty will be imposed. Okay, yeah. Then we'll move on to the requirements related to audit report. So we'll first of all start with the audit report, and that will also answer our question related to this problem of partnership firm which was not required to be audited, and in which case tax audit may become applicable as to how to deal with those unaudited financial statements. Okay, yeah. So in case of tax audit, two types of audit reports are available. Those two audit reports are called as Form 3CA or 3CB. These are again forms. These are again forms. Form 3CA, Form 3CB. So there are two forms, and when I say form, it means the format of the audit report. So these forms are basically the audit report itself, but it's a prescribed form. So there's a prescribed format which every auditor will have to use in relation to his audit report under tax audit. So let's understand about these two forms as to what do they mean. Means whether both of these forms are required to be filled or issued by the auditor, or is it like they have some criteria in terms of which form or which audit report will become applicable in certain situations. In case of a person who carries on business or profession and who is required by or under any other law to get its accounts audited, will issue his audit report in form number 3CA. We are saying this will apply. Okay, and we are talking about audit report. We are saying form number 3CA will apply in a situation when the financial statements of an entity or a person are required to be audited under any other law. Any other law means law other than Income Tax Act. And we have a very simple example again, and that of a company. Company. Each and every company is required to be audited. Means its financial statements are required to be audited mandatorily. There is no exemption for a company to get to not get its financial statements audited. And where does this requirement for audit come from? Can any of you tell me? Where does this requirement of audit come from? Yes, it comes from Companies Act. Companies Act mandates audit of financial statements of a company. So now let's apply this situation and let's consider this situation and check as to which form will become applicable or which type of audit report will become applicable for a company. If a company would have got its financial statements audited, means statutory audit for a company is completed. So we can say it's about statutory audit. And I am using this term statutory audit in the context of audit of financial statements covered as per Companies Act. In this case, for this company, when its Form 3CD will be filled, and in case its turnover exceeds 1 crore, then the auditor of this company will be required to issue audit report in this format or in this form. Okay, I'm repeating my point. I'm saying because this company has got its financial statements audited, and let's suppose tax audit is applicable on this company, depending on the thresholds, criteria that we have discussed, then in such a case, tax auditor will be required to issue report in this format using form 3CA. Clear? Yeah. Next is about form number 3CB. So let's see what is this form number 3CB and how is it different from 3CA, or is it like a continuation of 3CA? In case of a person who carries on business or profession but not being a person referred to in clause A. What is this clause A? This is clause A. This is clause A. Will be required to issue audit report in form number 3CB. Okay, will be required to issue audit report in form number 3CB. So now we are saying that let's suppose audit of financial statements of a person are not required. Like in our example, remember we took an example of a partnership firm. On this partnership firm, tax audit was applicable. They had a turnover of 5 crore. So they were required to fill form number 3CD, which was required to be audited by the tax auditor, but its financial statements were not required to be audited under any other law. Because for a partnership firm, no law mandates audit of financial statements. If the partners so desire, they can get their financial statements audited, but that is voluntary. There is no mandate, no legal requirement exists. In such a case, in case the financial statements are not audited, then for such a partnership firm, tax auditor will be required to issue audit report in form number 3CB. Okay, yeah. So with this, we can understand that these two forms are not in continuation to each other, and these are mutually exclusive in a way that either form 3CA or 3CB will apply to any person or any entity. Both of them cannot coexist. And what are the situations? Very, very simple. In case audit is already completed of the financial statements under any other law, then follow 3CA. Otherwise, we need to follow form number 3CB. Okay. So far, we have discussed about the requirements of tax audit and the audit report. But one of our problems which we identified, you remember, one of our problems which we identified in case of a partnership firm whose financial statements were not prepared, or maybe prepared but not audited. What is going to be the base was the financial statements, and whether that base is correct or not was not known to us because the audit was not complete. So we had that problem. Yeah. So far that problem is not yet sorted. So far the problem is not sorted. So we need to still find a solution to this. And we still need to understand as to how that problem will be sorted. So let's look at these requirements. Audit report in the format, that is form number 3CB, can be split into two parts. Let's see what are those two parts. The first part will require the tax auditor to give his opinion. Just give me 1 minute. The first part will require the tax auditor to give his opinion as to whether or not accounts audited by him give a true and fair view. Just 1 minute. and the other part will be talking about the particulars of form number 3CD. So we can move on to the format of form number 3CA. So this is actually a model form 3CA, you can say, or a draft form 3CA. So let's understand what does this form 3CA covers. In this case, auditor will start with this first para. Auditor will say, we report that the statutory audit of Messrs. Messrs means name of the company. So this is the company. Let's suppose this company is ABC Limited. So auditor will say, we report that the statutory audit of Messrs. ABC Limited was conducted by me, us, or maybe by some other firm. Because statutory audit of a company could have been completed, could have been conducted, not necessarily by a tax auditor. Another firm may also be involved in that. So the first para will be about this statutory audit or the financial statements. So we are talking about the requirements of audit report now. And this is very important because through this, we will also get to know about the solution to our problem. So the first para captures financial statements. Okay, or we can say audit of financial statements. So auditor in this case has reported that the financial statements are already audited. Number one. Number two. In the first para, then there can be various particulars around the financial statements, wherein he'll say as to how those financial statements have been audited in pursuance of the provisions of the Companies Act, and he'll also annex copy of audit report, copy of statutory audit report, along with copy of audited P&L, audited balance sheet, all the notes to come. So complete set of financial statements along with the audit report will be referred to in this first para. Then comes the second para. In the second para, the auditor will say statement of particulars required to be furnished under section 44AB is annexed herewith in form number 3CD. Now the auditor will comment about particulars captured in form number 3CD. So now he is referring to form 3CD. The role of tax auditor is what? To audit this, not to audit this. Correct? Because in this case, auditor has already audited the financial statement. So that's why auditor is starting with audited financial statements. He is keeping audited financial statements as the base. And he is talking about particulars in form 3CD. Then comes the opinion of the auditor. In the audit report, what is required to be given by the auditor? Opinion. His opinion is something which will form part of the audit report. And that is what will come in form 3CA. Now the auditor will say, in our opinion and to the best of our information and according to the examination of books of accounts, including other documents, explanations, verifications that I might have done, particulars given in form number 3CD, which have been referred in the point number 2 of the audit report, are true and correct. So the third para talks about opinion. And this opinion, as you can see, doesn't talk about true and fair. This is saying true and correct. Okay. And then the auditor says, subject to the following observations or qualifications, if any. Now this would mean that the tax audit report can also be a clean report or a modified report. In case there will not be any observations, then what will happen? Auditor will stop here. Okay, auditor will stop here. But in case there are any observations, there are any qualifications which the auditor want to report in his report, then the auditor will say, in our opinion, particulars are true and correct, except for or subject to the observations which he'll bring out in this para, point A, B, C, depending on the qualifications that he want to give. And then the auditor will give his sign off. Number 4 will be the sign off. Sign off means the signing by the auditor, which could be a partnership firm, which could be a sole proprietor, with his name, address, complete details, the way we have seen in case of statutory audit, and the place and date. Place of signing, date of signing, all of these particulars will come. Okay, yeah, all of these particulars will come. So easy to understand. And we can also say that this opinion may be qualified or clean. So I'm just saying this can be clean or qualified, depending on the observations of the auditor. Yeah, so I've written clean or qualified in this case. Now moving on to this form number 3CB. Let's see how is it different from form 3CA. So we'll now compare this form 3CB with form 3CA. In form 3CB, unlike in case of 3CA, we do not have audited financial statements to start with. In 3CA, it was very easy for the auditor to say financial statements are already audited and I have annexed those. But now auditor doesn't have the audited financial statements. So now this auditor who will be auditing the form number 3CD will also be required to audit the financial statements of the company. And that's why you can see this first para. Auditor will now say, I have examined balance sheet, P&L, beginning from 1st April 19 to 31st March 20, because it's a financial year that we consider in case of Income Tax Act. Attached herewith, which he'll attach, okay, giving the name of the company, address, PAN, etc. first. So now again, he will attach financial statements on which he would perform the audit. Same way like statutory auditor would have performed the audit of financial statements of a company. Then he will say, I certify that the balance sheet, P&L, or this complete set of books of accounts, yeah, then he will say, I will report the following observations, if any. Subject to above, we have obtained all the information explanations which were required for the purposes of audit. In our opinion, proper books of accounts have been kept by the entity which were required for the purposes of audit. In our opinion, and according to the information explanations given to us, if any, the said accounts give a true and fair view in case of balance sheet of the state of affairs, in case of P&L of the financial performance of the company. So now you can see various clauses have been added in form number 3CB. So first, he is attaching the financial statements which are audited by him. Then he is certifying that. Third, he is giving his qualifications, if any. Qualifications in respect of financial statements. Fourth, he is giving his opinion. Opinion on financial statements of the entity. Okay. And then comes the para, which also existed in case of Form 3CB, but that was point number 2. Now, prior to form number 3, prior to this point number 2, in case of 3CA, there was only a reference of audited financial statements. But now to capture this financial statements or the audit of financial statements, 4 things may be required to be reported. Or you can say all of these 4 things are now required to be covered by the tax auditor, as against this one thing which will be covered by the tax auditor in case 3CA will apply. Okay. So in summarized manner, what do we say? And this also solves our problem which we discussed in case of partnership firm for whom the financial statements were not audited. That in case the financial statements are already audited, then the auditor will give its reference and start with Form 3CD. In case the financial statements are not audited, then the tax auditor will need to audit the financial statements the way those are required to be done under the statutory audit. Same way. And after giving his opinion on the financial statements, after auditing the financial statements, he will start with the remaining requirements. That means about the Form 3CD. Okay. So this point number 2 will now become point number 5. So we can say this is about point 2 of 3CA, that is capturing particulars of Form 3CD. And then comes the opinion para on Form 3CD. So in 3CB, there will be 2 opinions. One, opinion on financial statements given by the tax auditor. Second, opinion on 3CD given by the tax auditor. So this is about the opinion on 3CD. Number 6. And what is number 7? All of these sign off, etc. All of these sign off, etc. So if you look at point number 5, 6, 7, they remain same. So if you look at 5, 6, 7, and now you can also look at the board. I think you will not be able to look at the board. Yes. Now if you look at this point number 5, 6, 7, they remain same. They are exactly same if you compare this to form number 3CA. But if you look at form number 3CB, then these 4 points will exist as against point number 1, which would exist in case of 3CA. Okay, yeah, understood the difference between these two and understood the requirement of form number 3CB and understood the reason as to why this requirement has been extended, unlike which is the case of form 3CA. Now going back to our problem of partnership firm, wherein we discussed that if the financial statements are not audited, then the particulars of 3CD will be audited, but the base may be incorrect. So now that base will also be sorted by the tax auditor. So now the tax auditor will say that the base that I'm going to pick up, the financial statements, now I will audit that. And once that is audited, then I'll move on to form number 3CD, which will again be audited by me. Okay, yeah. So I have few queries. I'll just quickly discuss those queries. Nishant is asking, sir, it means difference in 3CB is the tax auditor will be the statutory auditor. See, tax auditor can also be a statutory auditor in this case. So I'll not really say that to be a difference, because it may have happened that the statutory auditor of the company is also the tax auditor. So earlier he audited the financial statements and now he is auditing the form number 3CD. Okay, that is possible in 3CA also. But in 3CB, it will by default be same. Because in 3CA, tax auditor and statutory auditor may be different. But in 3CB, they will by default be same. But the role of tax auditor in relation to audit of financial statements is largely in line with what you see in case of statutory auditor. So he'll also be auditing the financial statements. Then Kamlesh is asking about the difference between sales, turnover, gross receipts, etc. See, all of these things will come down to a single point as to what will form turnover. For which again, I would suggest you one point, that for getting into the criteria as to how all of these turnover, etc. are captured, you should look into the requirements of Income Tax Act. However, there are certain provisions which you may consider which really don't form part of turnover. For example, if there is any sort of cash discount, so how do you deal with that cash discount? Will you exclude this from the turnover or will you not exclude it from the tax? This is one example I'm saying. And in relation to some of the discounts in the nature of trade discount, which will form part of invoice. So will you exclude it from the turnover or not? Yeah. So these are some of the factors which you need to be very careful about, and which are also very generic in nature, which can also be understood from the provisions of the accounting standards, because I would say mostly those are in line, but for this I would request you to refer to the provisions of Income Tax Act for sure. Then Chala is asking, sir, audit of non-corporate entities has to be done as per applicable laws or Companies Act? Yes. So in case there is any non-corporate, for which we move to form number 3CB. First of all, we need to check whether its accounts are audited or not. So we are not saying that for a non-corporate, we will always get into form number 3CB. No. Criteria says accounts should not have been audited already. Because otherwise, this will lead to a duplication. Can you see this? Otherwise, what will happen? Even if, so let's suppose the accounts are already audited and form 3CB is picked up, then the tax auditor will again get into the audit of the financial statements, which is a duplication, which is not required. So income tax is simply saying one thing. Income tax wants form 3CD to be audited. So what's the objective? Income tax wants this 3CD to be audited. Correct? Various particulars of 3CD will be picked up directly from the financial statements. We'll talk about 3CD also. Various particulars of this form number 3CD are picked up from the financial statements directly. For example, information about addition of fixed assets, deletion of fixed assets, gross block, etc. They can be picked up directly from financial statements. So that's why the base to fill form 3CD happens to be the books of accounts. And that is why audit of books of accounts becomes mandatory. So Income Tax Act says for filling this form 3CD, either the entity should have audited financial statements, which is fine with them. So they are not questioning about that audit. They are saying it can be audited under any other law. We'll accept it. But in case those are not audited under any other law, then income tax requires the tax auditor to audit the financial statements to start on this form number 3CD, and which is logical also. Then Ambika has a query. Ambika is saying the qualification which is not relevant to tax audit, it will not gain importance in the report, which may lead to unnecessary working of the auditor. So I think you are talking about this qualification. correct? We are saying some of these qualifications may not be relevant for Form 3CD or opinion on 3CD. So this may lead to unnecessary working for the auditor. No, I'll not say that this will lead to unnecessary working. See, any of these qualifications would be given if there is some material misstatement in the financial statements, correct? And the impact of material misstatement is what? That the profit may be misstated, loss may be misstated, or maybe other particulars of the financial statements may be misstated. When we will go through the requirements of form number 3CD, you will understand that various particulars of 3CD are dependent on that information of the financial statements. And in case we have a question mark, on the particulars which are flowing from the financial statements, so that means the base is not correct. Why? That is material misstated. It's very important to report that. And if the tax auditor will not be able to get to these qualifications, he may not give his opinion on 3CD in the right manner, because all of these particulars which may be flowing from the materially misstated financial statements may have materially misstated form number 3CD also. Yeah, so this is very, very relevant. Okay, so now we can move on to the next part, that is about engagement of the tax auditor. So we have now understood the requirements of the tax audit. We have also understood the requirements of form number 3CA and 3CB, which is the audit report. And we have also briefly understood as to what do we mean by form 3CD. Before we get into the detailed requirements of form number 3CD, we will understand the engagement formalities for the tax auditor. Now, engagement formalities for a tax auditor are largely same what we see in case of a statutory audit. Let's understand some of the steps which are required to be considered. First of all, eligibility of a CA. Now, CA can be a tax auditor. So eligibility, first of all, needs to be checked. So the first step will be to check the eligibility, whether the tax auditor is eligible for appointment as tax auditor or not, for which there has to be some communication between the management of the company and the tax auditor or the proposed tax auditor. So if the tax auditor is found to be eligible, then the next step will be about his appointment. For eligibility, there are various factors like independence, code of ethics, ethical requirements. Yeah, all of those aspects are required to be considered. His qualifications, the number of tax audits which he could do in a particular year. Yeah, so all of those stuff are required to be considered, and then the appointment of tax auditor will happen. Now, appointment of tax auditor is done for an year. So we do not have any sort of block in case of tax audit that tax auditor will be appointed for 5 years or will be subject to rotations. No. So tax auditor is appointed every year. Now, once the appointment has happened, what is going to be the next step? Next step will be about agreeing on the terms of the engagement. Agreeing on the terms of the engagement. Now, this step is very important. Agreeing on the terms of the engagement. So if you remember, we also have one auditing standard on this in relation to statutory audit. Yeah. So same is the case for tax audit also, and same are the provisions, same are the requirements for tax audit also, that before the audit is started, it is necessary that the management and the auditor agree on the scope of work, agree on the terms and conditions. Both of them should understand what are their roles, what are their responsibilities, what are going to be the deliverables, what are going to be the timelines. Yeah, all of these aspects are very, very importantly required to be covered, which is done by executing or by entering into a contract, which is called as engagement letter. Engagement letter. Now this engagement letter is similar to what we see in case of a statutory audit. So this engagement letter will detail out everything: scope of work, name of the entities, then responsibilities of two parties, management responsibilities, auditor's responsibilities, okay, what are going to be the deliverables, and the framework or the laws and regulations which are required to be considered, on the basis of which all of these audits will be conducted. Yeah, and various details will come in, and this engagement letter should be executed. Executed means signed by both the parties, means the entity and the auditor, before starting the audit. In many situations we see that engagement letter is signed after starting the work, which is incorrect, because only when two parties agree for the work, they should start the work. If they start the work and later on if there is any dispute, there is any problem, so will this engagement letter be of any help? No. It's an agreement which has to be done before starting the work. So that's why its timing is very, very important. Okay, yeah. And one thing which I missed out in terms of the important points is also about fees. Fees is again an important thing which is required to be covered. So that's about the professional fee which the tax auditor will charge, and this will also include various other terms and conditions to which both of these entities will be subject to, tax auditor as well as the entity. Entity means the company or the non-corporate which is subject to tax audit. Fine, yeah. Then I think now we can move on to the requirements related to form number 3CD. So now for this form number 3CD, we'll go through the various clauses and we will understand as to what all those clauses require and what are the audit procedures in respect of those clauses. You can now see form 3CD on your screen. So we thought it will be better to get into the actual Form 3CD. Actual Form 3CD means Form 3CD with those particulars which we actually see when we fill that Form 3CD, and then discuss the clauses around it, and then discuss the audit procedures around it one by one. One thing which we need to consider now is that even though you can see this Form 3CA, 3CB and this 3CD currently, maybe in the form of this PPT or in the form of this Excel or maybe in the form of Word file, but today or these days, all of these particulars are not filled in any hard copy. They are not filled in any Word file or Excel. They are all required to be filled and submitted online. Everything is online. So it's like any other form, as I told you. So your forms, as per my understanding, should be online, wherein you go to a particular portal, you fill the particulars and submit it, which can then be downloaded by you if you want, or in case you don't want, that record is available on the portal always. Same is the case of form number 3CD. So it's a form which is available online. There's a portal of income tax on which we can go and access this Form 3CD, fill all the particulars in various clauses which it will have, and once this is filled, then it can be submitted, on which auditor will put his sign off and the management will put its sign off. Sign off means sign. And unlike the hard copy signatures which are done in writing, digital signatures are required to be placed on these forms and on these audit reports. Okay, so let's now understand the background of form number 3CD, and let's try to relate to some of the concepts which are used in form 3CD or in this tax audit with statutory audit, because this is very, very important, particularly in the context of tax audit. There's a lot of confusion around this point. In case of statutory audit, I'm going to statutory audit now. Financial statements are prepared and those are required to be audited. Correct? Who prepares the financial statements? Management of the company or the entity. And what is the role of the auditor? To audit those financial statements. Is the auditor required to prepare those financial statements? The answer is no. That's not the responsibility of the auditor. Not at all. It's not his responsibility at all to prepare the financial statements. His responsibility is only to audit that. Okay. Now let's come to tax audit. Similar to what we can see in case of statutory audit, there's a Form 3CD which is required to be filled by the management of the company. So who will own this document? Who will have the ownership of this document? Form 3CD will be owned by the management of the company. They have the responsibility to fill this. Similar to what is done in case of preparation of financial statements. And what is the responsibility of the auditor now? Auditor will have the responsibility to audit Form 3CD. He will not have the responsibility to fill this Form 3CD. Yeah, if the management says that it's your responsibility to fill this, will that be appropriate? The answer is no, because auditor is there to audit, not to get into the management function. Because the auditor fills the Form 3CD, it's more of management function, because this document belongs to the management. Its ownership is with the management. Yeah, clear? So these responsibilities are very importantly required to be considered, because I've seen a lot of times there's a confusion. There's a confusion that this Form 3CD is also required to be filled by the auditor, because when he'll audit, he'll also fill all of those particulars. Once he'll fill the particulars, he'll sign it and submit it, because only then he will be able to control the form. The answer is no. This should not be considered to be the responsibility. Okay, clear? Auditor will only be issuing the audit report on this form number 3CD. Correct? Yeah. So let's begin with the particulars of form number 3CD. The first particular talks about name of the assessee, and I'm just hoping that this is visible to all of you. First particular talks about the name of the assessee. Now we'll start using these terms, assessee, previous year, because now we are using the language which will be used in income tax and not the language which is used in accounts or say in accounting terminology. Now who is an assessee? Assessee means the entity whose financial statements would have been prepared and whose form 3CD is now getting filled. Okay, yeah. So assessee means the reporting entity. So the first particular requires name of assessee to be produced. So this name of the assessee can be a company, can be a partnership firm, can be a proprietorship firm, can be an LLP, can be a society, or it can be anything. So this first particular will be filled by the management. Now, what is our role? Our role as an auditor is to audit this. Now, how can the auditor audit the name of the assessee? And another question may arise that is the auditor required to audit the name of the assessee also? For which you need to remember one point, that when the auditor issued his report form number 3CB, when he issued his audit report form number 3CB, he did not put any limitation over there. He covered every particular. You remember, he commented that the particulars in form 3CD are true and correct. So he is capturing each and every particular. So it may happen that there is some problem in the name of the company. Maybe there is some typing problem. Yeah? Or maybe the name of some other company has been filled in this form 3CD, but the auditor is engaged to audit some other entity. So that's why each and every clause of this form 3CD will require auditor to perform procedures. In case the auditor is not doing that, then he is taking a chance and he is not performing his audit procedures appropriately. Even if that clause appears to be very, very simple to him, audit procedures will have to be performed. And similar to what we see in case of statutory audit, another auditing standard will become applicable, and that is about audit documentation. You remember audit documentation? We discussed about this, that whatever work has not been documented will not be considered to be done. So if the work has to be considered, it is only possible by documenting each and every audit procedure. And the audit procedure is something which gives us the audit evidence. Okay, and these two basically go hand in hand. Audit evidence was what? It was all about audit procedures. Now same thing will apply in case of tax audit also. For all the audit procedures, it's very important for the tax auditor to have the working papers, to have them properly documented. If those are not properly documented, then again what is it that he has been doing? He is not following the requirements of this essay, and he will not have the evidence in relation to his opinion which he will be required to give in his audit report. Okay, yeah. So let's begin with the first clause, name of the assessee. So how can we audit the name of the assessee? Quickly, if you want to share any thoughts, you can just keep sharing your thoughts while we discuss all of these points. So the name of the assessee can be audited by looking at various documents. First document could be the form number 3CD of the assessee of the last year. So this can be the base. Form number 3CD of the assessee of the last year. This can be the base. What can be the other document? PAN of the company. On the PAN, name of the company would have been given. Correct? GST registration document of the company. that can also be one of the basis to check the name of the company or the name of the assessee. I'm using this term company in most of the cases as an example only. Yeah, so it will cover every assessee. PAN is something which will be relevant for almost every entity. So that's why that can be a very, very simple document to verify this. For different types of entities, different registration requirements exist. For company, registration is required with ROC. For partnership, there could be a partnership deed which may be registered with the partnership or with the relevant authority. For trust, there could be a separate registration with the relevant authority. Those registration documents will also or can also be used by the auditor to verify the name of the assessee. Then comes the next point about address of the assessee. Now, what is this address of the assessee? Address means the place of business. Now, this can also be verified using those same documents that we have just discussed. First, could be to the registration documents. So, registration documents will also have the address of the assessee. Registration documents will also have the address of the assessee. So, through those registration documents, all the addresses or the main address or the address of the assessee can be verified. And for each and every clause, generally, auditor will have a separate working paper wherein he'll put a tick mark, that address verified from the registration document, tick. In certain cases, he may want to keep a photocopy or maybe documents depending on his assessment, wherever he finds it appropriate. And some of these documents can also be referred to in his permanent audit file, which can also be compared to his permanent audit working papers, which is again similar to what we discussed in case of statutory audit. Number 3 comes PAN, permanent account number. PAN, permanent account number. Now the assessee will put his PAN, permanent account number, over here, okay, which is now required to be verified. So what's the way to verify PAN? Very simple again, by looking at the PAN card of the entity. And as I have discussed, PAN is something which is applicable to all. So for every entity, the auditor can get the PAN card. It may be in soft form or it may be in hard copy, whichever way it's there. And this can also be verified if the auditor wants. He can also verify it from the various portals wherein this PAN can be verified, whether this PAN belongs to the same assessee or not. Yeah, simply. Next point. Whether the assessee is liable to pay indirect tax like excise, service tax, sales tax, GST, custom duty, etc. Number 1. The first question needs to be answered. Who will answer this? Management. Whether they are covered under any of these laws or not. If yes, please furnish the registration number or the GST number or any other identification number allotted for the same. So this clause requires various particulars to be furnished. Now in this case, there could be a problem. Problem means problem related to furnishing of these details in the form, because some of these particulars may require a lot of space, and in the form, if we furnish all of these details on the form itself, then all of these details may not be really filled properly. That's why in various clauses, auditor will give the reference of an annexure, and in the annexure, all of these particulars will be filled. So that is something which is very commonly seen, that wherein a lot of details are required to be furnished against a single clause, auditor will prepare one annexure or you can say appendix or a separate document, and will give the reference of that document in this form or in this clause, like he has done right now. So he's saying refer attachment 1. In the attachment 1, all of the aspects related to clause number 4 is addressed. And who will prepare this attachment? This attachment will be prepared by the management. Okay. So let's see, what does this attachment 1 cover? Attachment 1 first of all answers the question by giving all of these particulars. So this entity was covered, was subject to GST and had various GST registrations. So in case it will have various GST registrations, all of those GST registration numbers are required to be put down. Place of business, because GST registration will vary on the basis of places of businesses. So that's why places of businesses have also been mentioned. So we can see a big list of registrations of this entity. Okay. Now this has been filled by the management. What is our role as an auditor? Our role as an auditor is to audit this. So how do we audit this? Again, very simple. By verifying the GST registration certificate. For all of these GST registrations, GST registration certificate would have been received by the management. Number 2, all of these GST registration certificates can also be verified on the GST portal of the entity. Every entity will have access to the GST portal. They have their own login ID, login password through which portal records can be verified. And portal is something, the portal which I'm saying is portal of the GST department. So the records which are available on those portal are something which is available in the GST department. So that can also be verified by the auditor, through which he can ensure whether all of these GST registrations are correct or not. In this case, in fact, under form number 3CD, the most challenging part which is faced by the auditor happens to be the completeness. So you can say, sir, is it about completeness assertion? I would say yes. So even if you look at this clause, wherein you can see that entity has provided this detail. So you went there as an auditor. Yeah, so you went there as an auditor and you asked for the details, and entity has produced 17 GST registration numbers in this clause, for which we said that the audit procedure is very simple. Just verify the GST registration certificates on the portal and we are done. But how can we ensure that the entity has got only 17 GST registrations, or it also has some more which have not been reported in this form number 3CD? So that's the problem which the auditor will have, and that is called as audit considering the assertion completeness. Okay. Now for this, what can the auditor do? Again, one of the procedures which the auditor can follow is to look at the GST portal. On the GST portal, all of those registrations of the entity would be available. Other than the GST portal, auditor can also verify all of the GST registrations of an entity by putting down the PAN number of the entity. So if you put down the PAN number of the entity on the portal, all the registrations which would exist against those PAN will be listed over there. And by performing this procedure, let's suppose if the auditor comes across 2 more registrations or 2 more registration numbers which have not been reported in this, then what is going to be the next step? auditor will discuss those GST registration numbers or discuss those discrepancies with the management as to why these two have not been reported. So maybe that management also missed out. For some of the entities which have got multiple registrations, it may be a problem. They may miss out reporting any of the registration numbers over here, yeah, which can then be corrected by the management. So they will upload this clause. They will update this clause by uploading more details. I'm saying uploading because all of these things will be online. So that's why they will have to update all the particulars in the online portal, or which is also very commonly called as, technically termed as utility. Okay, these are technically termed as utility. So clear on the requirements related to next clause. Next is about the status. Next is about the status. Now in the next clause, status of the assessee is required to be filled. Now what can be the status? Assessee can be a company, it can be a partnership firm, it can be a sole proprietor, it can be a trust, it can be a society, correct? Yeah, there are various statuses which an assessee may have. So when this particular will be required to be filled, a drop down window will exist. From that drop down window, status is required to be selected. But who will do that? Management. Auditor needs to ensure whether this status is correct or not. And again, what's the way to check the exact status of the assessee, whether it's a company, whether it's a firm, whether it's a proprietor, or maybe some other status. For doing this, for checking this, auditor can look at the registration document of the assessee. So wherever they are registered, they will have a registration document, and on the registration document it is always specified as to what is the structure of the entity, whether it is partnership firm, sole proprietor, or something else. Okay. Next two particulars are simple but at the same time important, because at times a mistake may be made in filling these two particulars. These two particulars talk about previous year and assessment year, and now the terminologies have changed. That's why it's very, very important for the auditor to understand these terminologies, and these come from the requirements of income tax, and I'm sure all of you must be knowing about these two. So what is previous year? Under Income Tax Act, financial year is called as previous year. Under Income Tax Act, financial year, or we can say the current financial year. Say if the form 3CD is required to be filled for 1920. Say if that is required to be filled for 1920, for which financial statements have been prepared. So we are saying current financial year, which is also called as reporting year. This is also called as reporting year. Then there is another term which is used, that is called as comparative year, or we can say comparative financial year, 2018-19. This is not the reporting year. Under income tax, we call 1920 as the previous year. Yeah, so no confusion should arise with this term previous year. Previous year for the purposes of income tax means financial year, or the current financial year, or the reporting year. That means the year for which all of these particulars are being furnished. And the assessment year happens to be the year following the previous year, or year following the reporting year. So that means 2021 will be the assessment year. Even though most of you will be familiar with these terms, but still it's better to clarify, huh? Now, how can this be tested? Again, you may have a question, sir, is this also required to be tested? Yes, this is also required to be tested because this will also be considered to be a clause of Form 3CD. This can be tested by looking at the financial statements of the entity which are getting audited, which have been audited or which are getting audited, whatever be the case, depending on whether it's falling under 3CA or 3CB. Okay. Clause number 8, it says indicate the relevant clause of section number 44AB under which audit has been conducted. If you remember, we talked about the applicability of the tax audit. You remember? It can be based on turnover, it can be based on professional income, or it can be based on presumptive taxation, etc. You remember all of those clauses we discussed? Now this 3CD will also require the entity to specify that because of which provision of that section tax audit has become applicable to it. And how will the auditor audit this? Auditor will verify whether the right clause, whether the right provision of that section has been picked up over here or not. Okay, yeah. Okay, so we can say that this happens to be the first part in relation to Form 3CD. This is basically divided into two parts, and first part is all about some of the basic information related to the entity. Basic information is about the basic particulars. Now, as we move forward, it will cover some specific details around various particulars, specific details around various details or particulars which will be flowing from the financial statements or from various other records. So it's now very specific information which will start from clause number 9 onwards. Okay, yeah. So we'll move on to this second part after our break. So now what we can do is we can take a break of 10 minutes. In case you have any query, you can just send your query and we can also have a discussion around your query. So after the break, we'll continue with our discussion on this form number 3CD. Okay. Hi, welcome back. So we can now continue with our discussion on this form number 3CD. We now starting with some of the specific clauses. So clause number 9. So it says if the firm or association of persons indicate, if it's a firm or an association of persons, indicate the names of partners or members and their profit sharing ratio. 9B, it says if there's a change in the partners or members or in their profit sharing ratio since the last day of the preceding year, particulars of such change. Now this is again all the information which will come from the registration documents, or we can say the partnership deed in case of a partnership firm. In case there's a change in the profit sharing ratio, that would also have been reflected in the amended partnership deed or maybe the new partnership deed. And so is the case of association of persons, which will also have the documents in relation to its constitution. So from those documents, this information can be verified by the auditor. Next, clause number 10. It says nature of business or profession of the assessee. 10B says if there is a change in the nature of business or profession, then give the particulars of such change. Now this clause will also come up with a drop down window. Now in this case, if you can see on the right hand side, when this clause has been specified, it reads manufacturing of other chemical products, and then it gives a code 04043. Now this code will have to be selected by the assessee while filling the form 3CD. So that means assessee will fall under any of the businesses or professions which would have already been selected by that form. There's already a window, there's already a drop down which will capture all of those particulars, and one of those particulars will have to be selected. Mainly that will be talking about the codes. Yeah. And in case there's any change in the business or profession during the year, then that fact will have to be specified. Now, as an auditor, this aspect will have to be verified in two forms. One, auditor will have to check whether this particular which has been selected in terms of the code or the business or this subline which talks about manufacturing of other chemical products, whether this has been selected appropriately or not. Number one, this has to be checked by the auditor on the basis of his knowledge of the business of the client. Now, as regards the knowledge of the business of the client, there are two ways through which auditor will know about it. Either he can be a continuing auditor. So in the last year, he knew about the business. So he also understands that the same business has been continuing. So that is one. The other way is that if he is only appointed for the current year, so that means he's starting off with new year, or even if it happens to be an odd auditor who has been continuing. So now in this case, he will be going through some of the business transactions like sales, purchases. He will also be going through the books of accounts of the company. He will also be having discussions with the management as regards their business. Because for any audit, we understand that the understanding of the business processes of an entity are required. So is the case of tax audit. So on the basis of his knowledge that he would have gained, and on the basis of his review of some of these documents of the company or the entity, auditor will get to know whether the particulars which are furnished under this clause are correct or not. Moving on to the next clause, that is about whether the books of accounts are prescribed under section 44AA. If yes, give the list of books so prescribed. Number B, list of books of accounts maintained and the address at which books of accounts are kept. Now, depending on the requirement which may arise from 44AA, in case any specified books of accounts are prescribed, then those particulars will be given. Otherwise, every entity which is preparing its books of accounts, preparing its financial statements will have a detailed list of various ledgers, various books, or various records that they would have been maintaining. So this clause requires all of those particulars to be furnished, and because there can be many particulars around it, that's why a separate attachment is included over here. So we can now go to that attachment and verify what are these particulars which have been furnished by the management. Okay, so now if you look at this clause, if you look at this attachment, it first of all starts with the reference of that clause, because multiple attachments may get involved now. Earlier we only had one attachment, so therein it was easy to track, but if multiple attachments will come in, so that's why management may lose track, or the auditor may lose track as to which attachment relates to which clause. So that's why every attachment will have the reference of the relevant clause. Now in this case, this is referring to clause number B and C of 11, wherein management has put down the complete list of the books of accounts maintained by it. And the management will also specify that out of these books which have been maintained by it, whether these books are maintained in manual form or a computerized form. So these days you'll see most of the books of accounts are maintained in computerized form, be it some of the softwares like Tally, SAP, Oracle, or any of the customized ERP packages they may be following, or some of the records they may be maintaining in, say, Excels, like, so for example, fixed asset register, which is maintained in Excel, and some of the documents may be maintained in manual form, which is rare these days, but depending on the size of the entity, those manual records may also exist. So that's why it's important for the management to specify all of these details. And some of the books of accounts which they can specify may relate to the cash book, bank book, various ledgers in relation to sales or purchases. Then they will also have a journal book. They will also have debtors register, stock register. So all of these requirements will be put down over here. Okay. Moving on to the next clause number 12, which is in relation to the presumptive income scheme. So it says whether the statement of P&L includes any profits and gains assessable on presumptive basis. If yes, indicate the amount and the relevant section. Now income tax has got various sections in relation to the presumptive taxation, presumptive income, on which presumptive taxation is required to be considered. Now whether the entity is falling under those presumptive taxation or not, that is required to be specified, and which section will apply to it. Now, as around this applicability, how can the auditor audit this? For this, auditor will again need to understand the nature of the business first, because only then auditor will get to know as to which of these sections will apply, means whether 44 AD will apply, 44 AE will apply, or 44 AF will apply. That means the knowledge of income tax will be required by the tax auditor, and also the understanding of the business will be required. And then the auditor will also need to understand whether the management is falling under this presumptive basis or not, which can again be looked at by looking at the records of the entity. Moving on to clause number 13. So this clause talks about the way books of accounts are maintained by the entity. First, method of accounting employed in the previous year. Now, method of accounting could be of two types. One is accrual basis and second is cash basis. So in this case, management is saying it's mercantile system. What is mercantile system? That is accrual basis of accounting. And how can this be verified? Auditor can verify this basis of preparation of books of accounts by reviewing the accounting policies. So an entity will have various accounting policies on the basis of which books are prepared, on the basis of which financial statements are prepared. That will give the understanding to the auditor as to how the books of accounts are prepared. Number one. Number two, when we start with the financial statements of any company, basis of preparation of financial statements is required to be specified, wherein the entity specifies that the basis of preparation is what? Accrual or cash basis. These days, it's all accrual basis, except in case of some organizations which are not for business or which are not for profit, for whom cash basis of accounting is allowed. This will also have to be specified as to which basis of accounting has been considered by the management, and this is how the auditor can also verify it. Next, if there is any change in the method of accounting employed as compared to what was done in the preceding year. So I'm using this term preceding year because with previous year we may get confused, because previous year, you remember, we are using this in the context of current financial year. So preceding year means year prior to previous year. So if there's any change, that change will have to be specified. And again, to know about that change, auditor can look at the records of the company. First record will be the accounting policy. So if there will be any change, the change in accounting policy would have been reported in the financial statements. If there would be any change, the accounting policy can be compared. Maybe a change in accounting policy has not been reported, but the auditor needs to go through the accounting policies which would have been used for the preparation of financial statements and books of accounts of the current year versus last year. So through that change, he will get to know whether any change is required to be reported over here or not. And third, which is not only limited to accounting policy, when the auditor will be performing various other audit procedures, he would be going through various accounting records of the company. On the basis of that also he'll get to know whether any change has come in or not. And last but not the least is the basis of discussions with the management. So on the basis of his discussions with the management also, he will get to know whether there's been a change in the accounting policy or not, or this accounting methodology or not. So C says, if this is an affirmative, give the details. D says, whether any adjustment is required to be made to the profit or loss for complying with provisions of ICDS notified under section 145 subsection 2 of the Income Tax Act. Clause number E says, if the answer to D above is an affirmative, give the details of such adjustments. I'm not sure if, okay, great. So I have one attachment available through which we can understand this in more detail. And the F says, disclosure should be given as per ICDS. Now this is something which is not very old as well as not very new, but another very important aspect over which we have seen there are a lot of problems. And that is because of the lack of the knowledge in relation to some of these provisions. That's why it's very, very important to take care of provisions like this. So this provision talks about certain adjustments which may be required to be incorporated in the income tax return. So let's understand what is this requirement and how this is required to be covered. So this clause says ICDS needs to be evaluated by the auditor. What are ICDS? ICDS are Income Computation and Disclosure Standards. Currently, there are 10 ICDS which are applicable to all the entities. So let's understand what do we mean by this. Say P&L of the company is computed. P&L of the company is computed, and on the basis of ICDS, certain adjustments may arise in the profit and loss, and those adjustments will have an impact on the tax of the company or we can say the taxable income of the entity. Now those adjustments may lead to increase in the taxable income or may lead to decrease in the taxable income. It can be either way. Okay, it may lead to increase or it may lead to decrease in the taxable income. Both of them are required to be considered. And because of these adjustments, let's suppose this P&L number happens to be 100. Okay, P&L I would say is about the profits because it's a profit. So we are saying it's 100. Let's suppose there's an adjustment which will increase the profits. So let's say it's plus 10. So the taxable income therefore will become 110, on which tax will be required to be computed. Yeah. So first aspect covers reporting of these type of adjustments if any of them exist. But a question may arise that what is this adjustment? What is this ICDS? How is this relevant? And how will this really bring in any adjustment? See, for the purposes of income tax computation, there are two things which are required to be covered. One is Income Tax Act. One is Income Tax Act. Its rules, various circulars, notifications. Another thing is ICDS. ICDS are the standards. Standards similar to what you see in case of accounting, like accounting standards. Standards similar to what you see in case of audit, like auditing standards. So for certain topics, Income Tax Department has also issued income computation and disclosure standards which prescribe certain criteria on the basis of which taxable income will be computed. So we are reaching to taxable income. So objective is get to the taxable income. Okay. Now, on the basis of various ICDS, auditor will want to now verify whether all of these adjustments have been considered by the management or not. Because if you remember, what was the objective of Form 3CD? Objective of Form 3CD was to get on to income tax return or to put down all the adjustments in the income tax return. Yeah, so that's why Income Tax Department requires Form 3CD. So if there are any adjustments which may result from ICDS, those should be properly analyzed. And this is one area which you will see practically is ignored. Okay, practically is not considered in the right manner, and that's why many of the adjustments may get missed over here. Other than the adjustments, there are various disclosures which each and every ICDS requires. And even if there are no adjustments, there are certain disclosures which this ICDS requires. Now, both of them are required to be reported in form number 3CD, and which will then be required to be audited by the auditor. Now, how will the management do this? Management will have to evaluate each and every ICDS, apply the requirements of each and every ICDS, and on the basis of that, ascertain these adjustments as well as the disclosure requirements. Plus the disclosure requirements. Okay, this is something which the management will be required to do. Now, as an auditor, what is required to be done? Now, all of these workings which will be prepared by the management, because auditor will not get into this computation, auditor will get into checking or the recomputation. So first step, all of these adjustments will have to be verified by the auditor. So he will verify the computations, or he can get into the recomputations. Okay. Now, while doing this, auditor will also have to ensure completeness. Now, completeness would mean completeness of provisions of ICDS. Now, ICDS is a standard. So let's suppose ICDS covers 5 provisions. Or let's suppose ICDS has 5 requirements. I'm talking about any one ICDS. But the management has only considered 4 points. 5th is ignored by the management. So how will the auditor get to know about this? Only when auditor will have knowledge of ICDS and he will be able to check whether each and every requirement of ICDS has been considered appropriately by the management or not. Okay, yeah. And all of these things will also apply to the disclosure requirements, on the basis of which auditor will be able to conclude whether the provisions of ICDS have been appropriately considered by the management or not. Okay, all of you clear on this? Yeah. Now on this ICDS part, let's understand certain situations and let's understand as to how an auditor may deal with some of these provisions. Now let's suppose any of the ICDS, or say all of these ICDS for a company. Let's say there's a company P Limited for which Form 3CD is completed and ICDS adjustments were rupees 10 lakhs. Okay, and the profit of the company, let's suppose, is rupees 200 crores as per the financial statements. So this adjustment is only rupees 10 lakhs and the profit of the company is rupees 200 crore. Now in this situation, management did not report this adjustment of rupees 10 lakhs. Why? Because they said that this is immaterial. They said it is immaterial considering the numbers of the profit, considering the size of the organization. So they do not want to report this. Can this stand of the management be accepted by the tax auditor? Yes, all of you think about it. All of you think about it. Can this stand of the management of not reporting a small adjustment of rupees 10 lakh be accepted by the management? The answer will be no. Management will have to report all of these adjustments. So management cannot say that this is immaterial, because 3CD doesn't talk about only the material adjustments. So if you read 13D once again, it says whether any adjustment is required to be made. So any adjustment will mean any adjustment, and for the purposes of income tax computation, can the management say that on this rupees 10 lakh they will not pay income tax because this is immaterial? The answer is again no. So we need to always understand that what's the objective of this Form 3CD. Objective of Form 3CD is to help the income tax department, through which if they require they can validate various particulars which will flow while computing taxable income of the entity. Okay, so that's why some of these stands which you get to see being taken by the management in case of statutory audit are not acceptable in case of tax audit. Okay, yeah. Next point. Let's suppose management doesn't want to report this. So we are saying that this stand of the management is not acceptable. But still, management believes no. As per my assessment, means as per the management assessment, this number is too small. And even in the context of these adjustments, they didn't get into detailed workings. They broadly computed all of these numbers, and management could get a perspective that the number would be in the range of rupees 10 lakhs, with which the auditor is also comfortable. So tax auditor is also comfortable, and tax auditor is also of the same view that if at all any adjustment will arise, that will be near around rupees 10 lakhs only. Okay. Now in this case, even though we are saying that the management should have reported this 10 lakh, management did not report this. Management said, no, I'll not report this in Form 3CD. Why? Because Form 3CD is my document. If I don't want to report anything, I'll not report. Now in such a situation, let's understand what is the stand which the auditor can take. So there are two parts now. For the management, we discussed that there's no materiality. Yeah, that is something we discussed broadly. And that's why for the management, it was important to report. But auditor will always have the materiality. Yes or no? Auditor will always have the materiality. Now, if the management doesn't have the materiality and they were required to report, but the auditor has the materiality, so can now auditor take a stand that this 10 lakh is within the permissible range. Permissible range means within the threshold of the materiality which the auditor would be using for the purposes of tax audit. And that's why, and on the basis of that materiality threshold, auditor can ignore this rupees 10 lakhs. What do you think? Any thoughts in case you may have? You can just keep sharing that with me. Now, in relation to this, can you tell me what is it that the auditor should consider in relation to this 10 lakh as to how it should be considered by the auditor? So can the auditor take a materiality stand and say if the management is not reporting, he is fine and he is not required to report this matter? The answer here again will be no. Why? Because something which is important on the part of the management cannot be ignored by the auditor. So let's suppose if the management doesn't report and the auditor then has a threshold because of which that reporting is then ignored by the auditor, then will the Form 3CD serve its purpose? No. For the purposes of Form 3CD, all of these clauses will have to be carefully assessed and should not be completely aligned the way reporting is done in case of statutory audit. Okay, so in this case, if the management still goes ahead by not reporting this adjustment, so what will happen? Tax auditor will have to report this matter in his audit report. You remember how the reporting is done? He'll say subject to this and this, or subject to this adjustment, my opinion is true and correct. Yeah, clear? Okay, then we move on to the next part, that is about disclosure requirements. So if you look at the disclosure requirements, they will not have any impact on the numbers. Correct? They will not have any impact on the numbers. Numbers means the numbers which will be used for the computation of income. But that is required. So if you look at this clause, so I'm just reading this clause once again. It says whether any adjustment is required to be made and the disclosure standard required to be made. And in clause number 13F, it says disclosure as per ICDS. For each and every ICDS, give the relevant disclosures. So I can show you the disclosures. Some of the disclosures which may come over here, and then we'll get on to the situation around non-reporting of disclosures also. So we have one attachment. Okay, so this attachment captures the disclosure requirements around each and every ICDS, relevant to the entity. So we are not giving this disclosure in a very general manner, relevant to the entity. So ICDS 1, for example, it talks about the accounting policies. So what will the entity write? Significant accounting policies adopted and followed by the assessee are as stated in clause number 13 of Form 3CD. And what was clause number 13 of Form 3CD? That was about the method of accounting. Then as regards the valuation of inventories, ICDS 2, it says, since the assessee is engaged in the activities of trading, let's suppose in our example, they were engaged in the trading business. Hence, this ICDS is followed by the assessee as stated in note number dash of the financial statements. Now, what is it that the management is doing? Management is talking about the valuation of inventories on which there is no change as per ICDS. Means as per books of accounts and ICDS, well, in this particular entity, and the entity is also giving the reference of its accounting policy which they have reported in their financial statements. That covers the disclosure requirement. Yeah. Number 3. Now this can be another important point to understand. ICDS 3 deals with construction contracts. And we are talking about an entity right now which is into trading business. So will an entity doing trading business be required to get into the construction contracts? The answer is no. They will not be required to get into any sort of construction contracts. Means these two are completely different. So what will be the disclosure here? Since the assessee is not engaged in the activities related to construction, hence this ICDS is not applicable to the assessee, and consequently no disclosure requirements which are given as per ICDS 3 will be covered over here. So here again, even though this ICDS is not applicable, still the management is specifying that this is not applicable to ensure that there is a coverage. So let's suppose if they delete this row, let's suppose if they don't report this, let's suppose after ICDS 2, management reports disclosure as per ICDS 4. So what will happen or what may happen? It may give a thought as if the disclosure related to ICDS 3 is missed or not given, isn't it? Yeah. So in this case, it may happen as if this has got skipped or this has been missed, which is not considered appropriate. That's why it's important to bring in the ICDS to ensure completeness, that all of the ICDS have been covered, and then specify that if by chance any ICDS is not applicable, then it's not applicable and why this is not applicable. So that will be considered to be an important disclosure. Okay, yeah. Now moving back to our question. So we are coming back to this P limited once again. Let's suppose P limited doesn't have any adjustment. So in our case, we were getting an adjustment earlier. Let's suppose they don't have any adjustments. Now in case P limited is not having any adjustments, you understood the adjustments? What do we mean by adjustments? They will not mean passing of any accounting entry. They will mean adjustments which will be required later on when the income will be computed as per the tax norms. Now considering there are no adjustments, nil, P limited believes that no disclosure is required to be given for any of the ICDS. No disclosure is required. And I think this is a very, very simple question which all of you must have understood and all of you must be knowing the answer for. No disclosure is required. So that's the view of the management, and that's why they have not given any disclosure. That's why they have not given any disclosure in Form 3CD. Do you think that is appropriate on the part of the management? Can this be accepted? Because if you look at the disclosure requirements, they will not impact the numbers. Isn't it? They will not impact the numbers. So considering that the disclosures will not impact the numbers, considering that disclosures are not also relevant because there is no adjustment in relation to any of the ICDS, will you say that the stand of not giving any disclosure by the management is appropriate? Yes, any thoughts from your side? Now, if you go to this clause once again, this clause doesn't limit the auditor or doesn't limit the reporting of this disclosure requirement only in case there is an adjustment. So it doesn't say that if there is an adjustment, give the disclosures. No, it says give the disclosures as per ICDS. So that means the reporting or the disclosure to be given is independent of whether there is any adjustment or not. So in case the management will not give the disclosures, saying that there are no adjustments will again not be acceptable. And in case the management doesn't do this, therein again what will happen? Auditor will have to put that down in his observations in the audit report. And you may be thinking, sir, but there's no financial impact, there's no impact on the taxable income. Even then, this observation will have to be put down by the auditor in his tax audit report. Okay, yeah, clear? Then I can see some responses from Ambika and John. Ambika is asking, sir, Form 3CD is filed by the management, but wordings of attachment 3 is like auditor is addressing the assessee. So the wordings you can ignore. Maybe some of the wordings are not really correct, but important thing which you need to remember always is that this Form 3CD is prepared by the management and which is then audited by the auditor. Ambika is then saying disclosures are mandatory, sir. These are required to be given. That's true. Okay. So then let's move back to form number 3CD. And now we'll move on to next clause. Okay, Aditi also has some point. Okay, Aditi has the same response. Aditi is saying, no, sir, the disclosures are compulsory even if there are no adjustments. That's correct. Any queries? Okay, great. So then we move on to next clause, that is about method of valuation of closing stock employed in the previous year. In case of deviation from the method of valuation prescribed under section 145A of the Income Tax Act and the effect thereof on the P&L, please furnish. Now this clause basically talks about the accounting policy. In the accounting policy, in relation to the preparation of books of accounts, method of valuation of closing stock would have been considered. Now method of valuation of closing stock, as we all know, are only two. Do you want to let me know what are those two methods of valuation? What are those two methods of valuation? First is FIFO and second is weighted average. Only these two methods are permissible. So any of these methods would have been opted by the entity. So that is required to be reported over here. Then there are certain specific requirements of section 145A which require certain adjustments to be done in the valuation of closing stock, which are required to be applied by the management, on the basis of which numbers are required to be reported in this clause. Now, as an auditor, what are the procedures that he'll perform? So first procedure, he will verify from the accounting policy of the company. He can also look at the valuation workings of the company. In case he happens to be the tax auditor who is going to issue form number 3CB, therein he will also be reviewing, he will be verifying the inventory valuation of the company. So he'll be knowing about this valuation mechanism. Then any of the adjustments which may arise from section 145A, those workings would have been done by the company. So those workings will have to be again verified by the auditor. So he'll have to check whether those workings are in line with section 145A or not. Yeah, which is generally reported as in another attachment. So we can also look at that attachment. So in this case, there were certain adjustments which were made. So increase in opening stock of raw material due to inclusion of VAT or GST as per the requirements of 145A. You may be thinking, sir, why it is required? Because again, we are not getting into the taxation requirements. Taxation requirements say this. And this will not change the valuation of closing stock in the financial statements. No, this is only for the purposes of reporting that number by considering that adjustment in the form 3CD. Then increase in opening stock of raw material due to inclusion of SENVAT, if any. Then it says increase in purchase cost of raw material due to inclusion of VAT or GST. So after including them, what is going to be the number? Because GST is something for which entity would have considered input credit. So this would not have got included in the cost of purchases in the closing stock. That would have been excluded, these numbers. But now after including this, what is going to be the number? Then it says what is going to be the increase in profit or decrease in profit due to VAT credit availed and utilized on raw material consumed in payment of VAT or GST output on finished goods. Similarly, increase in income due to inclusion of VAT or GST in the sales. So we are now going to look at the sales after including these numbers. So this is what is required to be done for each and every element, for opening stock, for purchases, for sales, and for closing stock. So all of these numbers will have a net impact on the P&L. So some of the items will increase the profit, some of the items will decrease the profit. So the net amount will be reflected over here. Correct? Yeah. And auditor is simply required to verify all of these workings by looking at some of the records like GST, VAT, etc. So all of these internal records will be available. GST portal will also show the input credit. GST records which are there in the books of accounts, they will also show the input credit, liability, etc., which would have been added over here. So all of those computations will have to be verified, and on the basis of supporting documents, all of those information will also be required to be checked. Okay. Then comes the next point, that is about clause number 15, which says give the particulars of capital asset converted into stock in trade during the year, wherein description of capital asset should be given, date of acquisition should be given, cost of acquisition should be given, amount at which asset is converted into stock in trade should also be given. In this case, it's nil, because in this case entity did not convert any capital asset into stock in trade. But in certain cases, this happens. So for example, let's say there is a company which acquires certain equipments, okay, which purchases certain equipments, and those equipments are used for production of inventory, production of finished goods. So what will you do with those equipments if you follow the accounting principles? Yes, any thoughts from your side? An entity acquires certain equipments using which finished goods are produced. So any thoughts from your side as to how will you deal with those equipments in the books of accounts of the company? So if you look at the books of accounts of the company, if you look at the requirements of accounting standards, which would have been followed while preparing the books of accounts of the company, such equipments would have been considered by the company or the entity as capital item, or we can say PPE, capital asset. Correct? And we are taking an example of equipment. Yeah. This equipment, let's suppose, was purchased for rupees 1 lakh. And this was used for 6 months, on which depreciation was charged. Let's suppose depreciation charged was rupees 10,000. Let's suppose the equipment was purchased for 1 lakh and depreciation charged was 10,000 for 6 months. Now, at the end of the 6 months, its WDV would be 90,000. Okay. Now, at times, in case of certain organizations, what happens is that some of these type of equipments are also traded, are also sold. So it means that some of their capital items are also sold like inventory. It's not something which they will do always. Otherwise, that will become their inventory in the normal course. In certain cases, because of their business requirements, because of the requirements related to some of these type of equipments, they may also be selling them. And when they sell this, they would be selling them as stock in trade and not as PPE. Now, this is another very important aspect to understand. You may be thinking, sir, if this is sold, can we not call this as sale of PPE? That means sale of a fixed asset. We can say that. But sometimes an entities keep doing it during the year because of their business requirements, wherein they first of all convert this into their stock. Stock which will be traded. So they will move this equipment from their usage of producing finished goods, or maybe for administrative purposes, whichever usage it may be having, to stock in trade or to inventory of theirs, which will then be sold. So if the entity will have any of these items, those are required to be reported over here in this clause, wherein the details around its date of acquisition, cost of acquisition, and the amount at which it's been converted into stock in trade is also required to be reported. Now, as an auditor can look at this information by reviewing the PPE schedule of the entity, by reviewing the fixed asset register of the entity, because that will show all of these movements. Auditor can also look at the inventory details, the stock details of the entity. And the auditor also needs to understand as to why some of these items are moved from capital item to stock in trade during the year. What was the reason of not moving this item directly into inventory? Okay, what was the reason of not moving this item directly into inventory at the time of purchase? So these are some important things which the auditor will have to verify and document in his working papers. Because at times it may also happen that there are certain capital items which have been purchased, let's suppose say closer to the year, and which may have been moved to stock in trade, but he has not been able to track it. So those items should not get missed out, and that's why all of these records will have to be reviewed by the auditor. Yeah. Then we can move on to the next clause, clause number 16, which talks about various clauses, okay, which talks about various items, whether those items are credited to P&L or not. So it says amounts not credited to the statement of P&L being items falling within the scope of section 28, pro forma credit, drawbacks, refund of custom duty, excise, service tax, refund of sales tax or VAT, where such credits, drawbacks, refunds are admitted as due by the authorities concerned. Now this point you should note down. Are admitted as due by the authorities concerned. Escalation claims accepted during the year, any other item of income, or any sort of capital receipt. Okay. So let's understand some of these examples and let's see what is the reporting requirement. Let's suppose management has got some pro forma credit or some drawback income, but that has not been taken to the P&L. Why? Because let's suppose they received certain grants, and grants were adjusted with the cost of the asset. If the grant would be adjusted with the cost of the asset, will that go to P&L? No, that has not actually gone to the P&L. But is that important for the assessment of the income tax department? Yes, they want to know this. So that's why they want a separate reporting of those amounts. Because if you look at the books of accounts, it's not visible. You cannot find out. But now you need to just go down, drag this information, okay, and put this information over here. In this case, you see this as nil because for this entity, this was nil. Now in this context, another point which is important is to know whether that grant or that credit or drawback or refund was admitted as due by the authorities concerned or not. Because in relation to some of these receipts or some of these amounts, there are various stages, there are various stages through which all of these refunds will go through. So for example, in relation to a drawback is a kind of incentive which is provided. It's a kind of grant which is received by the entities. So for drawback, first of all, the entity will apply to the authority. An application will be made that the entity is eligible for drawback, and in relation to some of these transactions, duty drawback should be paid to the entity. Then it will be acknowledged by the authorities. So they will acknowledge, yes, we have received this application and this will be processed. Then the authority will be processing that, on the basis of which they may have certain queries, they may have discussions with the entity, they may require some more documentation to review in respect of that drawback. Once this entire processing is completed, then the authority will admit this claim, or you can say admit this amount as due. That means they will admit that this is due to be paid by us. So the stage which is called as admitted as due should be considered to be the one which is required to be reported over here. Because depending on the accounting policy, depending on the accounting practices, it may have happened that the moment this duty drawback claim was acknowledged by the department or acknowledged by the relevant authority, it was recognized in the financial statements. So you could still see in the financial statements, not in the P&L, but in the balance sheet as adjustment of the amount from the asset. But will that be required to be reported in this clause? The answer is no, because that has not touched the stage of admitted. as due by the relevant authority. So only when this is at this stage, it should be considered to be considered for reporting over here. Now comes the problem for the auditor, because how will the auditor get to know about this stage? Because first two stages are very easy. It's an application made by the entity, so they will have the documents for application. Acknowledgement is again something which the entity may get to know. Now you may have a question, sir, how do we get to know whether this is admitted as due or not? So in relation to all of these claims, entities will generally have a regular communication channel with the authorities. So it will not happen that they will file an application and they will just stop, and when the claim will come, only then they will get to know whether this claim is coming or not, or the duty drawback is coming or not. Generally, there is a regular communication channel between the entity and the relevant authority. So auditor will have to track that communication channel. Auditor will have to track those communications. And in certain cases, the authorities also have their online portal wherein they keep updating the status of the claim. They keep updating the status of the applications as to where that application stands right now. Auditor can also verify on the basis of those portals, on the basis of those records, as to whether the status is admitted as due or not. In certain cases, this is also communicated in writing by the relevant authority. So that can also be verified by the auditor. Okay, on the basis of which this reporting will come. Yeah. Next is about any escalation claim. So any escalation claim which may have been received by the entity and which, let's suppose, has been adjusted, say with the amount of asset, but which has not been taken to the P&L, that is again required to be reported over here. All right. Yeah. Moving on to clause number 17. Where any land or building or both is transferred during the previous year for a consideration less than the value adopted or assessed or assessable by any authority of a state government referred to in section number 43CA or 50C, please furnish. And herein the format is also available. This format comes from the requirements of Form 3CD only. Let's see what is the format. Details of the property means the address of the property is required to be given. Consideration received or accrued. Value adopted or assessed or assessable. Okay, yeah. Now how is this clause relevant? See, let's suppose during the year a building has been sold by the entity. The cost of the building, let's suppose, was rupees 15 crore, and the market valuation of the building was, say, somewhere around rupees 16, or so, let's say somewhere around 18 crores. But the assessee has sold the building for rupees 12 crore only. Now there could be a problem. There could be a problem because it may have happened that the assessee has not really sold the building at the price at which it should have been sold. Because many a times it may have happened that assessee was in need of some money, so it was a sort of distress sale because of which he was required to sell this, which is fine. So he can sell it below the market price, okay. But the capital gain which will be generated on that type of transfer will be required to be considered by taking fair valuation of the building instead of the consideration price. So there are certain such provisions in the income tax. So I'm not again getting into the details of those provisions. Now, how will the auditor get to know about this? auditor will have to first of all verify the sales, for which he can look at the sales agreement. Next aspect is about the valuation of this. So whenever any sale would have been carried out, management must have got this valuation done. It will not happen that the management would not have got the valuation done. So that's why auditor should also request the management to get into to get the access to those valuation documents, on the basis of which he should be able to comment whether such reporting is required or not. In certain cases, if at all the valuation document is not available, then the auditor can also do certain inquiry procedures. He can also do some sort of assessment in relation to this type of sale. These days, a lot of data is available online on the internet. There are various sites which provide information about the valuation of various types of properties. So auditor can at least go through some of those portals, those information, on the basis of which he can then get to some information whether this sale is within the range at which it should have been made or not. And in case that is the permissible range, it's fine. Otherwise, he may require the management also to verify this. Okay. Moving on to clause number 18. I think it's a big clause, so that's why I'll just skip this clause for the time being. Clause number 18 is a big clause and very important clause for most of the entities. Yeah, so I'm just parking this for some time, considering the time of the session that we have. And anyways, we will have to continue with this form 3CD in our evening session today. So I'm just moving on to the next clause, clause number 19. So clause number 18 will cover in the evening. Now this clause number 19, let's understand what does it require. Clause number 19 says amounts admissible under section 32AC, 33AB, 33ABA, 33AC, 35(1), 35(1)(2), 35(1)(2) second A, then 35AD, 35CCA. There's so many sections which have been covered in this. So I'm not reading out all of those sections. I'm sure you must be knowing about all of those sections though. Then it says amount admissible under these sections which have been debited to P&L, showing the amount debited and deductions allowable under each section separately. Amounts admissible as per the provisions of Income Tax Act, and also fulfills the conditions, if any, specified under the relevant provisions of Income Tax Act or income tax rules or any guidelines, circulars, etc. issued in this behalf. So this section requires information to be put down in relation to some of these deductions which are available under Income Tax Act. Some of the reserves which may be required to be covered under the Income Tax Act. Now, what is it that will be required on the part of the auditor over here? First of all, auditor will have to ensure the very first and the most important point, whether any of such information is required to be furnished or not. Because it may happen that similar to what you see on the screen, management may say, no, nothing is applicable to us. It's nil. It's nil. Okay, so we do not have any such amounts. Now, even though management is saying it's nil, can the auditor just accept it as it is? No. If you remember, the most challenging area in case of tax audit happens to be the completeness, happens to be the coverage. So it may have happened that all of these sections are not properly analyzed by the management, and they have called this amount to be nil. Even in that case, auditor will have to do his independent assessment. So we are not saying that auditor will be required to fill the form. No. Even though management is calling this as nil, auditor will be required to check whether it should really be nil or any amount is required to be reported. And how will he get to know about it? on the basis of transactions of the entity, on the basis of some provisions which are required to be covered under all of these sections or any of these sections, which the auditor would know on the basis of inquiries with the management. He will have discussions with the management. For this purpose, and majorly in relation to tax audit, auditor will have detailed discussions with the taxation department of the entities. So if you talk about corporates or some of the large size entities or some of the medium size entities also, they have a separate dedicated team to handle taxation related matters. And even on taxation, there are dedicated teams for direct taxation matters and indirect taxation matters. So for direct taxation matters, the relevant personnel, the team which will be involved, that is the team with which auditor will have discussions. And on the basis of discussions of the auditor with those team members or those departments, auditor will first of all assess about the applicability of any of these provisions. And other than that, auditor will also be knowing about the transactions of the company, about various contracts which the company will be dealing into. Yeah. Moving on to the next clause, clause number 20. It says any sum paid to an employee as bonus or commission for services rendered, where such sum was otherwise payable to him as profits or dividend. Okay, let's suppose an amount has been paid to an employee and that has been called as bonus of the employee or commission for services rendered, but it was otherwise payable to him as profit or a dividend, because that was the nature of that amount which has been paid. Number 2, details of contributions received from the employees for various funds which are referred under section 36. Now for this contribution which will come from the employees, we have a separate attachment. Let's get on to that attachment. I think a very common one, very popular one, and something which you'll see in most of the entities. Details of contribution received from the employees in respect of PF. So this clause will cover reporting of the PF amount which the employee would have contributed every month, whether that has been deducted by the employer every month or not, because every month employer is required to deduct PF contribution of the employee from his or her salary, and that is required to be deposited with the relevant authority. So this entire amount which is deducted by the employer is required to be deposited by the employer on behalf of the employee with the relevant authority or with the relevant department. And there's also a due date prescribed for this. If that is not deposited within the due dates, then the interest is required to be paid by the employer, not by the employee, by the employer. Okay, yeah. So this clause will capture all of such funds in relation to which employees would have contributed and paid the amounts to the employer. Paid the amount to the employer because it's a deduction. So deduction is something which has gone to the employer or to the entity, and which is then required to be deposited by the entity with the relevant authority, whether that has been done on time or not. So it will say every month what is the amount which has been received from the employees. Then what was the due date for its payment? For PF, due date happens to be the 15th of the following month. For say August, due date will be 15th of September. Yeah. Then it will say what was the actual amount paid, whether the entire amount was paid or not. If there is any difference, that is required to be included in this clause. Management will include this. So it's not about auditor, management will include this. Then the actual date of payment. So even though the due date was 15th, whether actually it was paid on 15th or 20th or paid on 7th or 8th. So whatever was the actual date, that is required to be reported over here. Then comes the point around its checking by the auditor. Now, how will the auditor verify this information? First, auditor will verify this information from the payroll records of the company. Because from the payroll records of the company, auditor will know as to what's the PF that is required to be deducted, whether that was properly deducted or not. And if that was deducted, then around its deposit, auditor can check by looking at the challans. Because whenever PF will be paid, a challan will be generated. So year or month on month, a challan would be generated, which will then be verified by the auditor, on the basis of which he'll be able to check what is the actual amount paid and what is the date on which actual payment is made. And in case there are any delays, those will be required to be captured in this clause. Okay, though auditor will not be required to comment on them in his audit report. Yeah. So let's suppose if there are 3 delays in 3 months of any amount, and the management would have reported those 3 delays in this clause. So let's suppose there is another column in which they are saying delay of 3 days. So we put down another clause. Column of delay. So let's suppose instead of 2nd of August, this was 22nd August. So there was a delay of 7 days. Let's suppose instead of 7th of January, it was 17th January. So there was a delay of 2 days. So another column will show delay of 2 days and 7 days in 2 months. Now that has been reported in Form 3CD, included in Form 3CD. So now, will there be any reporting implication in this case? Will the auditor will be required to report these matters in his audit report? The answer is no. Answer is no. Because these are the particulars which were required to be furnished by the management. And if the management has furnished the particulars, whether there was a delay or not, then the auditor is happy with this. In case there is a delay, but the management is not showing that to be a delay, in that case it will be required to be reported by the auditor. But in case there is a delay which has been reported by the management, then there is absolutely no reporting requirement on the part of the auditor in his report, whether it is Form 3CA or Form 3CB. Okay, yeah, clear on this? Because this can again be a point of confusion. You may think, sir, but there's a delay. So if there's a delay, then at least the auditor should highlight this. At least the auditor should report this matter. Therein again, you should come back to the basic requirement. The basic requirement or the basic principle which has been considered for preparation of 3CD. Form 3CD says that all the particulars are required to be reported. It doesn't say that everything has to be done by the management on due date. No. It doesn't say every accounting done by the management is correct. No. It says whatever has been done in the financial statement is a separate matter. Now, on the basis of those books of accounts, on the basis of the financial statements, on the basis of various transactions, report the information or furnish the information in form number 3CD. Okay, clear on this? Yeah, so with this, we are done with clause number 20 also. We are still left with clause number 18, with which, we'll continue our discussion on tax audit. So I think we have come to an end to our session. So what we can do is we can just now close our discussion. In case you have any query, you can just send your query and we can have a discussion around your query in the evening session. So we are going to meet again in the evening when we'll continue with this form number 3CD tax audit and we'll also cover GST audit. Yeah. So thanks to all of you once again for your time and for your wonderful participation. Thanks so much.
Jay? Jay?